Welcome. In this video, ZBCN coin giant rally has started. We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When looking at the chart as a whole, it is clearly observed that the long-standing price consolidation has evolved into a descending wedge formation, which is frequently encountered in technical analysis and is considered highly reliable. These types of structures typically indicate that in a declining market, momentum is weakening, selling pressure is gradually diminishing, and buyers are beginning to gain strength. As the upper and lower boundaries of the wedge converge over time, the price movements within these narrowing limits represent a clear decline in volatility and an accumulation of energy signals that a breakout is approaching. In classical technical analysis teachings, descending wedges are mostly considered bullish reversal patterns. This is because the structure represents weakening selling pressure during a downtrend, in which the price continues to make lower lows and lower highs. Although buyers may not yet be in full control during this phase, exhaustion begins to appear on the selling side. Over time, as the price approaches the upper boundary of the formation, it eventually breaks above this resistance line with increased volume, signaling a shift in market direction. This exact scenario has been observed in the current structure. The price had tested the upper boundary of the wedge formation for an extended period and experienced significant consolidation in this area. Although buyers faced resistance during these tests, each subsequent attempt was more determined and came with higher volume. Technically, this indicated that the resistance was losing its strength and a breakout was becoming inevitable. As expected, the price made a strong move and broke out above the upper line of the descending formation. This breakout was supported not only visually, but also in terms of volume. In other words, the price didn't just move beyond the formation, it confirmed the breakout with a strong wave of buying. However, even more important was the retest process that followed the breakout. For many investors, the breakout of the formation alone is not enough. In a healthy trend reversal, the price needs to revisit the broken resistance zone and confirm it as new support. This testing phase is critical to determine whether the newly formed structure is temporary or sustainable. This retest resulted in the price pulling back to the upper boundary of the wedge formation and then rising again with strong buying pressure. In other words, the former resistance had started to act as support. This indicated that the formation had been fully completed and confirmed the beginning of an upward trend. Such structures in technical analysis usually provide investors with a new directional signal. Breakouts followed by successful retests from descending wedge formations often lay the groundwork for strong medium and long-term upward moves. The performance of the price following this retest further supported this scenario. The line that initially acted as resistance had now started to serve as a support, pushing the price upward. Each new candle close above this line gave investors more confidence and attracted new buyers to the market. The continued increase in volume showed that the upward move was supported not only technically, but also by the psychological approval of market participants. This suggested that the rally might be sustainable. Additionally, breakouts from such formations are typically associated with specific target levels. In technical analysis, the potential rise from a descending wedge is measured by taking the height of the formation at its widest point. This height is then projected upward from the breakout point and used as a potential target. When this measurement is applied to the current structure, the potential upside following the breakout offers a highly favorable risk-to-reward ratio. This further confirms the strength of the signal provided by the formation, but we cannot make decisions based solely on the formation. So let's take a look at other metrics as well. Stay tuned. A detailed examination of the chart shows that price movements have been progressing in a very orderly manner within clearly defined boundaries. Especially when looking at recent movements, it is evident that the price is moving within a stable upward channel. In technical analysis, this structure is called an ascending channel and is considered a strong signal for determining the general direction of the market in both the short and medium term. Ascending channels are structures bounded by two parallel upward sloping lines, with the price moving in a zigzag pattern between them. This structure indicates that buyers remain strong in the market, although sellers occasionally step in and cause minor pullbacks. However, these pullbacks are typically limited by buying interest at lower levels, which causes the price to continue making higher highs and higher lows throughout the trend. A similar technical setup is currently observed. The price has just completed a pullback to the lower boundary of the channel. These kinds of touches are generally interpreted as reaction zones in the market because historically, every time the price has touched this lower band, it has shown strong upward responses. The buying that followed these touches often pushed the price first toward the midline of the channel and eventually to the upper boundary. With the most recent touch, the price has once again reached the lower band and has shown clear signs of buyer activation. The buying response from this area indicates that the market is giving serious importance to this level and is positioning for a new upward move. Following this upward reaction from the lower band, the natural first target for the price would be the midline of the channel. Ascending channels typically fluctuate around this midline, which can act as both support and resistance. At this point, the midline acts as a technical balance line. When the price rebounds from the lower band and reaches this line, it may serve as short-term resistance. If buyers manage to stay strong and break above this line with volume support, it is quite likely that the move will continue toward the upper boundary of the channel. However, the price may also pause briefly here, which is why the midline is often considered a profit-taking zone. Every pullback to the lower band in an ascending channel is viewed as a potential buying opportunity from a technical perspective. Buying activity from these levels shows that upward momentum remains strong and that market participants are inclined to maintain the current trend. Additionally, the fact that this particular upward move has started more steadily than previous ones suggests that it might be more than just a short-term reaction, possibly the beginning of a deeper and more sustained upward wave. The increase in trading volume on the upside also supports this idea, as volume-backed moves are always considered healthier. Especially when strong buying occurs from the lower band with volume, it suggests the trend is building on a solid foundation and that participants are regaining confidence. This has a positive impact on the market not only technically but also psychologically. Investors begin to feel more secure and their expectations for continued upside are reinforced. On the other hand, the scenario that investors should be cautious of is if the price fails to break through the midline and pulls back again. In such a case, the price may head back toward the lower band. However, this should not cause panic, as such fluctuations are quite normal within ascending channels. In fact, this type of movement is part of the structure's nature. The important thing is that the lower band remains intact. A downward break of this level could indicate that the trend is weakening and may be nearing its end. However, based on the current price structure, there is no such threat at the moment. In conclusion, the price's upward reaction after touching the lower band of the ascending channel and its move toward the midline is a technically healthy and expected behavior. If this structure continues, it is entirely plausible for the price to progress toward the upper boundary of the channel from a technical standpoint. Careful technical analysis of the chart shows that the price's recent movements are approaching an important level. In particular, the current position of the price points to the 200-day exponential moving average, a vital indicator that many traders and technical analysts in the market are eyeing. This level is of great importance for both long-term traders and swing traders, as it is often considered as a barometer of the overall direction of the price. Currently, the price is hovering just below this strong average level and is touching it from below. In technical analysis, such contacts are considered critical decision points, because if the price is able to cross this level from the bottom to the top, there will be a significant shift in market psychology. This shift usually signals that the selling pressure is over and the buy side is starting to regain control. A price action below the 200 EMA is often an indication that the market is in bear market conditions. However, this is not absolute, because when the price falls below this average, it doesn't always mean that the decline will continue. What matters is how the price interacts with this average. And this is exactly what is happening right now. The price is approaching this long-term trend indicator, and a decision at this level is only a matter of time. 200 EMA is the long-term trend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.